6 o'clock, I'll make a start. Welcome to tonight's meeting of the Audit and Rewards Committee. Members and officers, please remember to switch microphone on and speak directly into the microphone and switch off again after speaking. Reporting officers using Teams, please switch cameras on and use the hands up icon to indicate questions and comments. The chair will invite you to speak. The meeting this evening will be live streamed to the public, and a recording of the meeting will be available on the council's website within 24 hours of the meeting. Any exempt private items on the agenda, the live stream will cease prior to meeting moving into private. There might be a short delay. Any apologies?
Yes, Chair. Apologies for absence from Councillor Masood.
Thank you. Minutes of the meeting, as members are agreed. Everybody will get a chance. Javeria, minutes of the last meeting. Thank you. Section 106.
None I'm aware of, Chair.
Any disclosure of interest?
Yes, Chair. We have disclosure of interest from Councillor Javeer Hussain and also Councillor Akbar if he joins us in items 5.1, 10 and 11 as they are both directors of LAO.
Thank you. Any urgent business?
Yes, Chair. Agenda item 5.1, which is the value for money report, but if we could take that following item 10, which is the audit results report.
Yeah, we do. Any references from committees and other bodies?
None, Chair.
Thank you. We move to agenda item 7, then corporate risk update. I think it's Concha. Thank you.
Good evening, everyone. The corporate risks update report is to provide the committee with an update on the authority's corporate risks and the risk management work being undertaken. Paragraphs 7 to 9 of the report provides details of the 4x4 risk assessment matrix and the criteria which is used by the council to assess both the likelihood and the impact of a risk occurring. Can you hear me? Yes, it is. Shall I walk back and forward a bit? Can you hear me okay? That one, I'll shift over. So this is the corporate risks update report for the committee to provide an update on the authority's corporate risks. Paragraph 7 to 9 of the report provides details of the 4x4 risk assessment matrix used by the council and the criteria in order to assess both the likelihood and the impact of a risk occurring. It also details the 4 T strategies which can be used to manage risk. If I can take you through to paragraph 10 of the report, currently there are 40 risks on the corporate risk register. Since the last update to the committee, the IT risks have been refreshed and the Care Act compliance risks have also been reviewed and revised in light of the new adult social care reform requirements. From paragraph 11 onwards, you can see an update in relation to the refresh of the IT risks. Luton Council are committed to ensuring that IT systems and residents' data is protected from malicious activity and misuse. And in order to do this, it is fundamental that there's active management of the cyber risks. to identify both the challenges and to ensure appropriate mitigation activities undertaken. The table at paragraph 13 details the corporate IT risks which have been refreshed and defined in a more granular way in order to identify the challenges and the action being taken to reduce the risk. So there are 4 new risks which have been added. If I can just briefly take you through this. Each risk is at a different level. So the first risk talks about the permanent service disruption following a successful cyber attack. The second risk talks about the severe business disruption as a result of a cyber attack. Then you have the next level down, which is as a result of a cyber attack, the council data is exfiltrated by criminals and data is published. And the fourth risk is in relation to the council will suffer financial loss or reputational damage as a result of email phishing or social engineering. So this talks about the potential fraud aspects around the cyber risks there. In order to mitigate these risks, the key strategy, which is going to be adopted by Executive in September, is the new cybersecurity strategy. And it sets out the approach for the Council in terms of managing the cyber risks in accordance with national standards. And it also drives a cyber work programme, which is governed by the Council's senior board. In addition to this, we are also required to carry out annual cyber training and awareness, which is carried out by staff. The next section talks about the Adult Social Care Reform and Care Act compliance risks. There have been a number of high impact reforms as a result of the changes in relation to the white paper for people at the heart of care and changes to legislation. The key areas identified in paragraph 14 is in relation to the changing of the charging reform, which introduces a lifetime cap on care costs of £86,000, changes to the means testing. Also, that there are changes in relation to the fair cost of care and market sustainability, new safeguards introduced in relation to liberty protection safeguards, and new measures introduced in relation to the local authority assurance in order to assess both the providers, local authorities and integrated care systems. Section 15 of the report talks about, whilst there is only limited information available in relation to the reforms, these areas have been assessed by the risk owner, and they have started to look at the overall impact on the council. And this would include the need to develop comprehensive communication and engagement plans for residents to understand these key changes. There's an expectation that there'll be an increase in overall number of queries and complaints where people are seeking to understand their progress towards the cap, or they're seeking to challenge the decisions around eligibility. There will also be impact on staff resources, expected that this will also increase workload. Changes to IT systems will also be required, and there'll also be budget implications in relation to increasing the council's purchasing care budget and potential funding gaps which may be identified as a result of this. To oversee these risks, a programme board has been established and separate work streams have been set up which will develop as further details on the key areas become available. As a result of this, the existing Care Act compliance risk has been reviewed and updated, and a further risk has been added to the corporate risk register to take into account the financial element of these reforms, and these are detailed in the table at section 17 and section 18 of the report. Section 19 of the report details the direction of travel of each risk since the last update. So of the 40 risks currently on the risk register, the risk prioritisation has remained the same for 34 risks, increased for 1 risk. For 5 risks, it's not applicable as these are the new risks added to the risk register. The heat map at section 20 of the report provides an overview of the council's risk landscape. And as you can see there, the greatest number of risks are currently assessed by risk owners as medium high priority. 6 of those risks have been assessed as high priority and are at the top right end of that table there. Section 21 of the report details the 6 high priority risks currently on the corporate risk register. So this is in relation to failure to keep to the approved budget. You have the risk around failure to recruit and retain staff. The current demand profile, poverty and looting continues to result in an overspend on the agreed budget, and this is in relation to temporary accommodation. Failure to improve the decline and look of the town centre, and then the 2 adult social care reform risks, which I mentioned above. I'm happy to take any questions on that, Chair.
Thank you, Concha. Any questions, please? Thank you. Yeah. Can committee recommend this report, please?
Agreed, Chair.
Thank you for your report, Kancha. Can I move to agenda item 8, internal audit plan update? The same, Kancha, you?
Thank you.
Thank you.
This is an update on the work of the Internal Audit Service for the first quarter for 22-23, and the recommendation is for the committee to receive the Internal Audit Plan Update report. If I can take you through key parts of the report, Section 6 of the report discusses that the annual audit plan is risk-based. It's prepared in consultation with management and also approved by CLMT and Audit and Governance Committee. It is intended to be indicative of the work that will be done during the year, but it does have to remain fluid so that resources can be appropriately directed. The annual audit plan is resourced by calculating the number of chargeable days available within the internal audit team, assuming that we will have a full complement of staff. For 22-23, this has been increased from nearly 7 full-time equivalent to 8 full-time equivalent, and the additional post is to enable the team to undertake a comprehensive audit plan for the council subsidiary companies and to increase audit coverage for the council. The projected chargeable days for 22-23 are therefore 1,380 days, which is an increase of 180 days from last year. At the time of writing this report, we do have 2 full-time equivalent vacancies within the team, and recruitment to these posts is underway. To make up some of the shortfall, 2 members of the team are working additional hours, and we also have access to a framework agreement for the provision of services from Mazars as required. We are required to record our time against individual jobs, which helps us to report on the progress against the annual audit plan. As at the end of quarter 1, we achieved 22% of the plan. We also have a number of performance indicators which we report on quarterly, and these are detailed in Appendix B of the report. Section 11 of the report details the audit work we have undertaken for quarter 1. So as at the end of quarter 1, we issued 9 final audit reports, of which 1 was issued a limited assurance opinion. The update on that particular opinion was provided at the last committee meeting in July, and it relates to audit work which was completed in 21-22, but where the final report was finalised in quarter 1. In addition to the final audit reports that we issued, we also certified a number of grant claims to confirm that terms and conditions of the grant were met, and submitted a number of fraud and error returns to BEAS in relation to the COVID business grants. As part of our follow-up process, all limited assurance audit reports which have been issued will be followed up approximately 6 months after the final report has been issued, and on conclusion of these reports, we will provide an update to both CLMT and the committee on the status of those recommendations. Section 15 of the audit report discusses the follow-ups we undertake on all other follow-ups. So in the year to date, we have followed up on 108 recommendations, of which 86 were high or medium priority. Of these, 59% have been fully implemented, 40% have been partially implemented, and 1% has not yet been implemented. And the reasons for these are detailed in Appendix C. Quarter 1, we normally expect the percentages to be a little bit low in quarter 1, but hopefully as the year progresses, we should see that increase through the year. In addition to those recommendations which we have followed up, we are also waiting to confirm implementation for a further 95 recommendations, of which 79 are high or medium priority, and these are detailed in Appendix D. And Appendix E lists the audits where a final audit report has been issued, but a follow-up is not yet due. I'm happy to take any questions on that, Chair.
Thank you, Kancha. Any questions, please? Yeah, Underwood, please.
Thank you, Chair. Okay, Shan. So the 2 full-time vacancies, do we anticipate filling those imminently, or?
So we have the 2 full-time vacancies. One is related to the principal auditor, and that is currently being advertised internally at the moment, with a deadline for the submission around the 7th of September. And the other post is in relation to the senior auditor, which is being advertised externally at the moment. So again, 7th of September is the deadline. So after that date, hopefully we should be able to start the process in terms of interviews and have a look at where we are at that stage. Thank you.
Thank you.
Thank you. Councillor Javaria.
Thank you, Officer, for the report. On page 56, so that's Appendix B, the final bullet point there, the quality of output in the results as at the 30th of June. Actually, sorry, the one before that, audit reviews delivered within budgeted time. There is a phrase here, grant claim certifications. Could you just clarify what that means? Thank you.
So this is where the council has received grant funding from various schemes. So, for example, we received a lot of grants in relation to the COVID grants. There were various grants relating to the business grants and a number of other ones. And as part of the scheme requirements, there is an internal audit required to confirm that the funds that the council have been received, they've been used for the appropriately in accordance with terms and conditions.
Audit processes that need to be met in order to comply with those. Okay,
that's right. And there's also a declaration which needs to be signed
as well.
and returned to that effect.
Okay, all right. Thank you. Thank you, Chair.
Thank you, Julie. Any more questions? No. Thank you. Thank you. Sorry. Councillor Wahid.
Sorry, Kanchan. It's page 57. The 50% qualified staff. What's is that the requirement, or what is the target?
So this is one of our best practice targets, if you like, in terms of the staff that we have within the team. At least 50% of them should be qualified to be able to kind of undertake the type of work that we require them to do. So whether they have a professional qualification or the relevant experience in able to undertake that work. And as you can see, 6 of the 7 staff, 86% of them are qualified or training for a professional qualification. Yes, we've met that target. So our target is at least half of the individuals within the team should have a professional qualification, and we're meeting that target. Thank you.
Thank you, Councillor Akbar. Yeah. Any more questions? Does committee recommend this report?
Yep, agreed.
Thank you. Thank you for your report, Kancha. Can I move to agenda item 9? Is Treasury Management Annual Report, year ending 31st of March 2022, and I think is Steph. Oh, sorry, John.
Thank you, Chair. That's myself. For those of you that don't know me, I'm John Chance, Chief Accountant and Deputy Section 151 in Dev's team. So this is the standard Treasury Management Outturn report for the financial year 21-22. 3 recommendations around submission to exec and full council. A note on the increase in borrowing for the year to substantiate and fund a range of capital projects, and importantly, that none of the prudential code indices were breached. So we're well within our limits, our targets, etc. That's the main issue for the report. There's information about the future outlook of interest rates and other indices from our Treasury Management Advisors, Arlene Close, and it does a synopsis of the Prudential Code indices at the end of the report, and that's pretty much it, really. It's a fairly standard report. Happy to take any questions.
Thank you, John. Any questions? Recommendation? Yeah, Councillor Underwood.
Thank you. That's just like a general question about interest rates. So we're taking advantage, or we have taken advantage of the low interest rates that we've had up to date, but obviously interest rates are going to rise. How long do you think this is going to last, and is it going to have an effect on, what sort of effect will this have on the council's finances?
Thank you, Councillor. Yes, it could well do, and we're thinking about more short term than long term. I mean, we need to factor in what our advisors are saying, and we've got to be cognizant of what's happening at the National Treasury, because clearly things could change. But we need to be in step with it and take advice accordingly. So it's a crystal ball gaze really, but. We would take our considerations, and take advice on the situation before we make any decisions.
Thank you. One more question. Paragraph 33, the strategy is to reduce the level of investment using investments as they mature to help fund cash flow. Is there any danger in doing this? Presumably, if you're using investments as they mature, you can't do that indefinitely, because once they've matured and you've used them, they've gone. Have I got that right? Yeah.
I think, yeah, again, so just to put in context, just following from the point you made is absolutely a good point, which every treasury manager is thinking. So just to give members reassurance, the bulk of our loan to the LAL, bulk of those loans we've already fixed, and we fixed rate which is below what we were putting in our budget and medium-term financial plan. So there's an element of borrowing as discussed, I think we discussed at FRG, where we have our cash. So we've got our reserves, and our reserves are technically represented in cash. So what we do is we use those reserves in order to fund some of our capital program, because otherwise we keep those reserves, we will generate just 0.2 or 0.3% in terms of interest. But on the other end, we go and borrow at 2-3%. So that's what we do call internal borrowing. So internal borrowing means rather than borrowing from external, we've got enough, the reserves, 70-80 million. So those are the reserves which we do internal borrowing. In terms of short-term investment, that's what John mentioned. Right now, when we're talking about a period where interest rates are quite high compared with historically, and interest rate, whether it go further up or will come down, it's very much difficult to forecast. So in Treasury, we have to look at our advisor to say whether we can borrow short term, and then when the time is right, then we can have to borrow some more long-term investment. But in the meantime, we'll use our short-term borrowing in terms of the internal borrowing, using our reserves to do that internal borrowing. So from a borrowing level, we can still borrow, but why we have to borrow when we've got our internal cash, which is here. And that's what we do the treasury management on a daily, weekly basis. And about 3 weeks ago, there was a drop in the gilt. So the rate dropped and we secured another 50 million. So when the time is right, we'll fix those. But it's come to a point here we can use our short-term borrowing in order. But there are some couple of projects coming in the pipeline, and the LUF, which is the leveling up fund, that project is coming to executive. So we'll have to think, and those projects which we are going to commit, those are the ones which will have to stress test the business case to see if there's a decrease in interest rate, how we can cope within those stress test scenario. So any future commitment, LUF, or if we are thinking of investing in some housing, those are the one HRA which will have to keep an eye on those. So it's a risk which we'll have to monitor closely. Thank you.
Thank you. And it's a standard practice, this form of financing. There's nothing unusual, or right?
The internal borrowing is we've got a choice. So if we've got cash, which our reserves, we've got the reserves, that reserve is represented by cash. So we can take this cash, leave it in the bank, we'll generate short-term 0.3%, and then on the other end, we can borrow at 2 to 3%. So if you've got the cash sitting in our bank, which is generating an interest of 2.3%, why should we go and borrow? So we use our internal resources first, and then when there's a need to go to borrow, then we borrow. But the capital program which we have allow us to borrow that limit, but if we've got internal cash, then we use our internal cash before we go and borrow. And that's normal sort of treasury management practice, internal borrowing.
Councillor Javeria, please.
Yes, thank you, Officer, for your report. Paragraphs 44 and 45, I believe they're on page 75. Obviously, we talk about the GDP growth in obviously the Eurozone, and then the following paragraph after that talks about the UK economy. I'm just saying, are those references in there for completeness, or is it the case that we just need to be aware of what's happening internationally as well?
Thank you, Councillor. Yeah, indeed. It's a bit of both, really, yeah, for completeness and also a wider context of what's happening internationally. So I think it's informative for the reader, and it gives a context, and we get this sort of thing, when we talk to our advisors on this sort of thing, and so it's standard to include it.
So it's a case of making sure that we're well aware of what's happening in those two areas as well, because obviously they may have a knock-on impact on us as well.
Indeed, yes,
Okay.
it's a global issue, post-COVID, and all the implications are still ongoing.
Absolutely. Okay, thank you.
Thank you, Javeria. Any further questions? Thank you. To the members, Audit and Governance Committee recommended to approve for submission to Executive and Full Council the annual report on Treasury Management and Prudential Indicators for the year ending 31st of March 2022, which summarize and reviews the Council's Treasury Management activities for the 2021-22 financial year. Subclass 2 note that there has been an increase in the amount of external borrowing, 89 million during 2021-22, which is financing Council approved projects. Note that the Council did not breach any of its prudential limits. Does committee approve the recommendations?
Approved, Chair.
Thank you. Can I move to agenda item 10, audit results report?
Yeah, Councillor.
Report.
Councillor Javeria Hussain.
Apologies, Chair. I'm about to be a pain now.
Yeah.
Can I declare an interest, myself and also Councillor Wahid Akbar, in relation to items 10, 11, and also 4.1, the value for money urgent item, as we're directors of LAL.
Okay.
And we've also taken advice from the monitoring officer, and obviously we can't participate in this. So if it's okay with you, we'd like to leave.
You need to leave. Yeah. You can't take part here. You need to leave. Yeah. Yeah, thank you. And I believe it's Janet and Neil. Yeah, thank you.
So I'm going to deal firstly with our audit results report update and just talk you through the key points of that and assume that you have read it. We are aware that the Council has not yet approved its accounts to the 31st of March 2019. The Council has not yet produced a set of accounts that reports the position at the 31st of March 2019 accurately. So the set that was presented to the Audit Committee at the end of July was, in our view, materially inaccurate. We've since seen another version dated the 15th of August, which still contains material inaccuracies. Our report sets out 5 key areas of the audit where we've been unable to gain sufficient and appropriate audit evidence to provide an opinion. We believe those matters are material and pervasive to the financial statements, and as a result, we are considering a disclaimer to our audit opinion. So we have serious concerns that the finance team are unable to produce materially accurate accounts, And informing that view, factors we've taken into account include the lack of ownership of the responsibility of determining the entries in the statements of accounts and an over-reliance on us in EY to identify those errors and the required corrections to the significant accounts within the statements. The number of attempts that have been taken to update the accounts to reflect the 31st of March 2019 airport valuation and prior year adjustments required, which remain wrong in the draft accounts. It's important to note that this has been ongoing since before we presented our interim audit results report in January 2022, which highlighted these same areas of concern. The inconsistencies that exist in the set of accounts between the primary statements and the supporting notes, which have not been updated to reflect changes in the primary statements. There appears to be a lack of understanding of the adjustments that are required to make other associated values changes and disclosures in the accounts related to the issues to do with the valuation of the airport. And there appears to be a very stop-start approach being adopted by the finance team to be able to deal with these issues. Now, we do recognise, as we've pointed out in our Value for Money report, that the finance function is under severe stress. They don't have sufficient capability and capacity within the team at the moment. And I think if you look at management's response to the points that we've raised, that is also recognised in their response and was discussed at the previous audit committee meeting. So the options as we see them for the council are as follows. We're very well aware that the management response sets out the intention to correct the position. So you could therefore seek to resolve the remaining material errors, update the accounts and approve them on a timely basis. In our view, that will require additional external support to the finance function in the form of specialist accounting support, additional external support to the Director of Finance in the form of quality assurance of the output to make sure that it meets his responsibilities, and additional support to the Audit Committee in the form of both being able to gain assurance that the output meets the reporting requirements before we re-engage to complete the work required to report an opinion. Without those safeguards in place, it's not possible for me to comment on the likely timing of the conclusion of the audit, given the time it's taken to date to get to this state and this draft of accounts. And we can provide no assurance at this stage that our opinion will not be modified even if such additional work is done. Your other option is to approve the accounts as they stand, recognising that they contain material errors. We would then issue a disclaimer opinion referring to those areas where we are unable to obtain sufficient and appropriate evidence and which we believe are material and pervasive to the financial statements. We'll then work with the council to determine the impact of that disclaimer on future periods of account and reporting. What this would do is it be to allow the council to move forward with its financial reporting and allow us to focus more fully on more recent financial decisions and risks that the organisation faces. This may be better value for money for local taxpayers than spending significantly more time and resources on further work on the 18-19 accounts. But clearly that is a decision for the organisation and for the audit committee in terms of what you now want to do. But that I felt it was important to set that out very clearly for you as the audit committee. I'll come on to the VFM report if you have questions on the financial statements piece first. I might just add, in the management response on item 4, we note that pensions information has been changed, but we have not yet looked at that. On item 5, it states that management will respond to EY requests for changes to the accounts, but actually we need to be clear that those accounts are management's responsibilities. And on A5, just to clarify, we have not yet expressed an opinion on whether or not the range of the valuation for the airport for 2021 is tolerable. So we have not yet expressed an opinion on that. So I think those are important just to put on the record. Thank you.
Thank you, Janet. Any questions?
Yeah,
Jackie.
yeah, it's okay. This is to the auditors and to Dev. So either way, I need to understand with the material errors, if we was to go with option B in your scenario, it's still going to have an effect on future years, and there is still an issue of capacity, is there not? Either way we go on the path, there is still a question of capacity that will carry on playing out. Have I got
You
that?
have, yes, you have
Yeah.
understood that correctly. So if we disclaimed our opinion in 2019, it affects the opening balances for the 2020 set of accounts. So we can do additional work, but we would still carry an element of limitation of scope or qualification on the opening balances position. And then,
So what
Yep.
we're talking about with the 18-19, it will affect 19-20, 20-21. But the material error, one is unclear how far it goes into the future or rolls into the future. Yeah.
but then you have transactions the following year that you're able to audit, then your opening balance in that following year is still, you still can't provide assurance on, but you can provide assurance on the transactions in year because you can audit those, and therefore the closing balance and then transactions into the following year, you can start to lift the qualification because you can build the assurance on those.
If the first mistake is there, as each year is closed off, hopefully the error, so say 100%, say you got, it might reduce because 1 year is totally assured. So the closing balance of each year, the material error will reduce and juice, but one cannot foresee how long that's going to go into the future. I've got that.
Well, it depends on the nature of the balance. So it's a bit more complex than that, but it would reduce over time. The impact of it on the opinion would reduce over time, depending on the type of balance we're discussing and the type of transactions.
Not to be raising this as an issue.
Exactly.
The type of error must be significant for we to be here 1, 2, 3, 4 years potentially, because we're in 2021, 22, we're into the 22, 23 financial year. So 1, 2, 3, 4 years on, the route is quite materially significant to support potentially 5 years later. Have I deduced that correctly?
Well, we haven't looked at the 5 years later yet because we're still stuck trying to close out the 2018-19 accounts.
Good to have before. I'm sure there was challenges, but for my brain to quickly assimilate and be ready for questions. But Deb, do you want to?
Yeah.
Do you mind, Chair, if I ask Deb to come in on my question? Are you okay with that, Chair?
Yeah, so
Thank you.
I think we fully respect EY view, and they have to take the view as an auditor, and they've got guidance which they have to follow in order to sign off the audit opinion. But outside the audit, we've got to put it in context. So if we take it out of context, then we have to put it in context. So first, in terms of the disclaimer, I've had this discussion with EY. We have been working on these accounts. This we are coming to the final part. And that my report says, 2 years we've come a long way. When it started, when the pandemic hit, we were faced whether the council or LAL is a going concern or not. And that was first main concern of EY. So we had to put a stabilization plan. We had to deal with the airport. We had to deal with having a capitalization directive from central government. We had to deal with central government review, where the report came out was positive. We had to deal with a special force majeure, which was only resolved after, I think, 16, 17 months. So all these things which I have been doing is in order to bring in a position where 18, 19 accounts, and you have to remember we're talking about 18, 19 accounts in September 2022. And the main reason why we're going in 18-19 account is all those post-balance sheet events, which are the results of the pandemic. So we have to put in context, we are signing in accounts 18-19 for the users in September 2022, where we've already got 2021 accounts 21-22 published on our website. So that's the context. In terms of an impairment, if we work so hard to reassure about the council and the airport has got strong footing, we've resolved the special force margin, we've got a plan how to deal with those. Airport is recovering, and that's the main reason why we are where we are. The other point which we'd like to make here, when we're talking about the accounts, the council accounts, I will come to the pension issue and other things which have been mentioned in the report as misstatements. We're talking about the group accounts here. So the council LBC accounts, with the exception we talk about the pension, the council LBC accounts, there is not significant misstatements in the council accounts. So that's the point which I would like to make. And the council account is the account on which the council set its budget, revenue budget, and everything. So the impact on the council revenue budget, we have to make it clear because it's absolutely the revenue budget which has been set in the budget. I will come to those items which is recorded that misstatements won't have an impact on the council revenue budget. And that is important because when we're talking about the group accounts. So the misstatement and errors, we start with the one which is the easiest one. The pension one, this was something is unfortunate that those staff, both EY staff who work on 17-18 accounts and the council staff who work on the 17-18 and 19-19 accounts, they're no longer with us. So the team has been prioritizing dealing with 19-20 audit plus preparing 21-22 accounts as well. So we've got a limited amount of resources. So when you're dealing with pandemic, all the special force measures, stabilization, going concern issues, plus 19-20 audit, plus 18-19 accounts, plus 21-22 finalization of statement accounts, it will stretch any team. So I agree with EY. Given the workload we have been working, we've all stretched. Yeah, but we have to put it in context that the workload which is coming, you can't deal with 3 years accounts in one go. Plus you've got budget, we've got, yeah. So we've done as much as possible. If you look at the track record over 2 years, despite this capacity, we've stretched ourselves to make sure, yeah. So we'll start to deal with one by one, okay? So just to put in context so that at least yeah. So EY quite rightly pointed out the first point, which is the misstatement. And here it's to do with the valuation of the airport. The valuation of the airport, we have been discussing about the 2021 valuation, which by and large, we agree the concept and the principle, there might be a landing zone. Any valuation when you're talking about airport was 1.4 billion, there is a tolerance. So within that tolerance level, although I agree with Janet to say that figure has not been signed off because it will be signed off as part of the 2021 accounts. But that figure we've discussed quite a lot, and by and large, within that tolerance, we agree. But because we are signing 18-19 accounts, and in order to protect public purse, rather than spending on significant amount on doing evaluation, we try to take a simpler way, and which was one of the approach agreed by PwC as well, because they've signed LAL accounts for 2021. So the approach which we use is just roll it back rather than going and having a full-blown valuation. And this we have been discussing with EY, the state team, PricewaterhouseCoopers, and everything. So because the principle of the 2021 valuation has been agreed, the discount rate has been agreed, we took a simpler view. So with hindsight, absolutely EY are right in what they're saying, but that might be a simple way, but the real figure has to be properly valued under risks and everything. And you have to do evaluation not for just 18-19, but 3 years, 16-17, 17-18, 18-19. And 3 years full valuation will full certificate full justification of the discount rate. So the consequence of that is if we don't do that, then EY are mindful to do an impairment and disclaimer, which I don't think working so hard over the years, the end result, we have a disclaimer. And that has to be resolved, as Councillor Burnett, you've said, 1920, we have to resolve it. So why not just resolve it in the loss? So that is to do with the valuation. So we have to have, and the reason why we have to have 16, 17, 17, 18 valuation, because when we're signing 18, 19 accounts, we have to have the account signed by EY, which is the prior year, which is 17, 18 as well. So when you have 17, 18 prior year adjustment, then you have to have 16, 17. So we've already contacted, you will see in my response, Deloitte already working on that, because Deloitte are the valuers for LAL, so they're already working on that. Once we've got that valuation done, the PricewaterhouseCoopers tax advisors are already working on the deferred tax liability. Those are the two big numbers, which once we've done that, so prioritizing that, they couldn't work on this because of holiday. Once they've done this, will deal with the main, I wouldn't say misstatement or an error, but it's a value which hopefully will satisfy EY's team. So that will be done, and that's we are aiming to do it ASAP and just a value. As I said in my response, the first response from Deloitte is potentially the value of the airport, the value will go up and not down. So it is a positive on the valuation.
So can I just summarize that I've got this right?
Yeah.
So one of the significant part of the material error is to do with the valuation of the airport. And you're saying it goes back, we need to go back to 16, 17, 17, 18, 18, 19, which would then be prior year adjustments to those accounts which have already been signed off. And once that is done, working with the auditors, one should be able to move forward. But so besides that being is there anything else, or is there more than just the valuation of the airport in 16, 17 as a material error?
Yeah.
Sorry, Chair, am I okay to ask that?
Yes.
Thank you.
I'll just add one question. I remember, Dave, I think in January meeting time, we asked for the valuation, and Deloitte, how long they will take, or when council asked them for the valuation, and if you ask them what's the normal procedure, how long they will take?
Absolutely right. So at that time, when we are discussing the valuation, we are talking about 2021 valuation, because the airport accounts were not signed. So the airport accounts was using the 2021 valuation. That's why we discussed with EY to get that right, because that was the most recent one. And our colleagues wanted the airport accounts to be signed so that the group accounts can be signed. So that was critical. And we discussed quite a lot, and the value of the airport was by and large within the range of 1.2 to 1.4 billion. But I'm saying these figures can change, plus minus a couple of 100 million. It's the order of magnitude. So that valuation was done. We've discussed with the EY team, and we by and large, there's a tolerable zone. We've agreed on those figures. So once this is done, that's why we took a simpler way, not to spend too much money on having a full-blown valuation, and try to use a simple way to roll it back rather than a full-blown with Deloitte certificate and everything. But now we understand that we have to do that. And straight away after the meeting with EY, I've instructed Deloitte to do that full rigs with the valuation. And for them to do that, then they have to do that, and they've agreed to do that. It's not that they can't do it. And they have to go for their own quality assurance and everything. So they have to do that, and yeah, because signing a valuation with their certificate, and they have to do that. For 2021, they've done it, and they've got the certificate signed, so they have to do that. So we need to have 16, 17, 17, 18, 18, 19, and 19, 20 as well. But I'm trying to ask them to concentrate up to 18, 19, because that is more important to get these accounts signed. So just coming back to, so the point is, yes, 2021 is done,
Time, how much time they take?
They took
for the 18,
maybe,
19 valuation?
yeah, it went on a while because we wanted to make sure EY are comfortable. So we had several meetings with EY, several meetings with Deloitte, LAL, LBC, and EY team, the state team in EY. So we didn't want to produce evaluation where, because evaluation is evaluation, but we wanted to get something done so that we are all comfortable. So EY team was look at it and they said there is a difference on opinion on the discount rate, but it's within that lending zone. Now, PricewaterhouseCoopers took a slightly different view, but we are talking about this. So the council account here. So that took a bit, maybe 2-3 months, because there was a lot of backward, forward, the cash flow and everything. But we've agreed on a figure by and large. Now, the next point here is, and if I'm saying something, I'm sure Janet and Neil will correct me if something is. So the next is about the DCO, the deferment consent order costs. And that's in the accounts of 1819, around 20 million. And this as well, if you look at all the discussion we have been having over the last sort of 9 months about how this is going to be treated in the accounts, and has gone to EY, we've discussed, we produced, as I said in this report, we've produced a report from our QC, report from AROP, our consultant, and we also had the LAL auditors, PricewaterhouseCoopers, who agree with our consultant and AROP. So in PricewaterhouseCoopers, as an auditor in LAL accounts, they are comfortable with the treatment of the DCO. But EY absolutely, they are our auditors and we have to work with EY to sign off our accounts. But EY view, we've produced all the evidence, but EY come to a view that the evidence is not sufficient for them to form a judgment on that. So on that one, we've discussed on several occasions and we agree to say, it's a bit agree to disagree on that and put a limitation of scope to say on that particular point, EY cannot form a view because of those costs. So that is the point which we have been discussing, and I was discussed as part of the January when it came to audit committee. So then we come to the third point, which is infrastructure assets. And that was discussed with our colleague. And this is something which is faced by all the council throughout UK. This is something even SIPFA issued a consultation document and they haven't even reached a conclusion. We are waiting, and EY us waiting if SIPFA was coming with some directive or some recommendation, or Deluxe were coming with some exemption, then every council would have. A lot of council accounts are being held because of these infrastructure assets. And this is basically, it won't have impact on the bottom line figure. All these things won't have impact on the council bottom line figure in terms of the general fund. So in the absence of SIPFA or Deluxe coming with some, we've agreed on this one. If there's a limitation of scope, that's fine, because other council are saying, how long are we going to wait? So the infrastructure asset is not an error or misstatement. It's just, it reflects that council has not been treating them properly, especially those assets where it's fully depreciated and part of the component is fully depreciated and it's sitting in the bigger part of the asset. So until we've got confirmation from SIPFA, 1819, the best thing is to agree with EY can't form on the infrastructure asset. But it's not just us, it's a lot of council are in a similar position. So then we've got the fourth, which is the pension. Pension, as it's unfortunate, all the EY staff who work on this in 1819 and the staff from council who work on those 1819 both have left. So we were concentrating on getting the 21-22 statement of accounts done. So we couldn't look at this. Once the account was done, my team went and looked at it and we picked up why there was that error. And this was in fact reflected in 17-18 accounts, and even in EY audit results report, it was reflected, exact figure. So once we've spotted that, once we've done this account, it was circulated, the next day, we say, let's look at it back. Because we can't do 3-4 different things at the same time. And that's why sometimes the quality suffers. So we look at it straight away, we found that error, and we say that's why there was a misstatement. And that has been corrected, we've already dealt with it, and that will be resolved. So that another misstatement done. Then we come to the final one, which is, and we agree with some of the, as I said, when we're working on so many things, the quality suffers. And we agree with that. So now since we've dealt with 21-22 accounts, hopefully John will be free to deal with 19-20 audit with the auditors. And I've asked the closure accountant to concentrate and deal with those. In fact, he's already produced a draft which I have to go through. And then I agree with our colleagues here. I will secure the help of somebody technical. Because as Councillor Burnett, you mentioned, we're talking about a prior year adjustment in 16-17 in September 2022. And then an estimate of a value in 16-17, 17-18, 18-19 in September 2022. So those disclosures are not normal disclosures. In normal year, it's fine, but those disclosures are complex. So we will secure, once we've done that, the advice of a very specialist technical to go through and read it, somebody really technical, and if you have to pay for that, we'll pay for that, and at least go through that and then present to our colleagues. But one of the things I would say here, although I agree with Janet, is the responsibility of the council to produce a set of accounts. Absolutely, I agree. But you have to put it in context. When you're dealing with so much complex issues, any council hasn't got that level of expertise. So that's why we always say, if EY can help us, because some of the things is they've got more expertise, and just say, these are the areas where it's not. And they have been doing that, and we are taking these on board. And any audit, you would expect an audit to find some things which needs to be corrected. And that's why we go adjustment, corrected, not corrected. It's a normal process, but this is a highly complex. So we're talking about big valuation, we're talking about group adjustment, we're talking about prior adjustment, uncertainty, judgment. These are very complex things. I personally think after all we've done over the last 2 years, we're just close to that. And the main one, we got the valuation, and we've done the valuation for 2021. And even 17, 18, 18, 19 valuation was done, and the accounts were signed. So that won't be an issue. It's just Deloitte producing and agreeing with EY. Pension done. DCO, we already agree that if that's the view of EY, that's fine. It will be, Prasa's view is different. They're saying that's fine, they're okay, but EY is our group auditor. And then the adjustment is just fine-tuning those adjustments. The adjustment in itself won't change the numbers, but you just get the numbers right, get the UI Deloitte valuation right, and change those numbers. So those are the main thing which we are concentrating now, prioritizing, because at least 21, 22 accounts, which you will see, we've done that. And if we did bring more capacity, but one of the things I've mentioned here, and I think our colleagues will agree, we're only struggling with having good technical staff. And it's not just us, the Deluxe has acknowledged that local government overall is struggling to have good technical, and I'm sure my colleagues here as well, they have sort of resource as well, because some audit firm are struggling to produce those on time. So we're only struggling in terms of, and not just finance, the other profession. But I think I'm comfortable we will put all the final bit which is left now. So just to summarize, just wanted to put it in context, because we've done a lot over the last 2 years. With EY, we work quite a lot, but just this final push now. The main one is evaluation, and the rest is infrastructure and DCO. We've all by and large agreed on those. Pension is resolved and just subject to EY going through. So I think it's that bit which will just last final bit against a disclaimer of the accounts, which is not of the working so much, just that final bit. We'd rather get this done, because if we don't resolve it now, we have to resolve it for 1920 anyway. So 1920 audit is ongoing. We have to resolve it. Let's work together and get it done. So that would be, sorry, it was a bit long, but it was necessary to put it in context sometimes. Yeah, but I agree with my colleagues. Is from an audit point of view, absolutely pure from an audit point of view, I agree. Whatever UI say, we've already done. It might cost, not it might, it will cost LAL having 3 years valuation quite a significant, but if that's what you have to do, we have to do it. That's no problem, we'll do it. Thank you.
Thank you. Yeah, Underwood.
Thanks, Chair. For the valuation of the airports, so the way I'm reading this report, it's down to, the difference is down to how the range of possible outcomes of the discount rate, and which discount rate you use to value the airport. That seems to me to be is that not quite a simple thing to resolve? I mean, what is the problem with the discount rate and the range of discount rates?
I can respond to that. Okay, it's a bit like you ask an opinion from two lawyers, you have two opinions. So accountants you ask for a valuer, they might come with two different valuation. If you ask for an accountant, that's where we are. So the discount rate is something which is very technical. I don't want to go into technical, but there is a way you work the discount rate to come with a figure, and that figure in this valuation is critical. A 1% up or down in the discount rate, as Neil pointed out and Janet in the report, can end up 100 million in the valuation. So that's just 1% can up. So the way it was discounted is quite, and that's why Janet mentioned we have to follow the RICS. The RICS Israel Institute of Chartered Surveyors use how they so properly and come up with discount rate. But if you put three valuers, they might come with three different discount rate. But what we have to do, we have to discuss, and that's what we have been doing with EY, come with a discount rate, which when you discuss with the Janet and her team, they're comfortable with. There's no point of coming with a discount rate and EY say, we don't agree with this, we are going to disclaim. But we rather agree on a discount rate which our colleagues are comfortable and avoid a disclaimer. So if you look at some of the discount rate you have been using, there has been a sort of margin of 120 basis point, which what Deloitte might view a discount rate, which is to be used, and where EY state team. So there's always there might be 100 to 200 basis point. So yeah, 2%, yeah, 202%, and 1 or 2% is significant. And as our colleagues mentioned, the materiality for them to sign the account is 6.4 million. So just imagine the discount rate goes by 1% and it's 100 million up or down, that's significant. So I fully understand is for EY to be comfortable, we need that proper valuation and the discount rate, and discuss with EY to agree on something which we agree, and then use that figure. So we are going to do that for 16, 17, 17, 18, and 19. Free, full-blown valuation carried by Deloitte. And then when you do valuation, there's deferred tax liability, which PricewaterhouseCoopers are already on the standby. When they get the figures, they will run that model. We've got those, and we'll put it in the account. So that's the main thing. Now, there might be some of the cash flow, because the valuation is based on cash flow. So that as well, there's a view on the cash flow, and that's what we'll discuss. But the point which I'm making, which I feel more comfortable, because we've done that for 2021. So for 2021, PricewaterhouseCoopers, there might be a difference with PwC, the way they view the discount rate, and most of them discount and some of the reversion release. But I think the approach and the lending zone, we've agreed. It's just we have to do the same thing for the 3 years. So we'll be discussing, because we can be sitting here another 3 months and discussing about discount rate. But I'll rather agree a discount rate which our auditors are comfortable and get the account signed. So, and that has been my view with what you say. If you're comfortable with a discount rate, which despite the Deloitte discount rate, but if the discount rate you're more comfortable, I'm quite happy to go. Because I think to put it in context, we're talking about a value in 1819 in September 2022. So what value this will bring to the user of the accounts when they're more interested, what is the value in 21-22? But I fully 100% agree with, for our colleagues to sign, it has to reflect what that value was in 1819. And the whole thing is because of pandemic. If there was no pandemic, we're very close to signing 1819 accounts in, I think it was February 2019. I was going through the email, and that was February 2018, 19, 2022, just before the pandemic hits, and it's just everything froze. Yeah, but I think I'm always the glass is half full rather than half empty, but they're just close to finalizing everything. That's my view. I'm quite happy if Janet.
Thanks, Deb. I think the only comment I would make, and it's in the summary to our ISA 260 update report, is at the bottom of page 1 and onto page 2. I think we just need to remember that when we came with our audit results report in January, we made it clear that there was an error in the basis of the valuation. So in previous financial years, the 16-17 and 17-18, the valuation assumed that the concession agreement with the airport would run in perpetuity, and there was not a break at the end of the concession agreement. And there is a residual interest that the council and LAO will have at the end of the concession agreement in 2032. So that led to an error in the basis of the valuation. That came to light at the point at which LAO was preparing the valuation for 2021. And so whilst previous accounts have been signed off, it's on the basis of a fundamental error in the valuation. And so therefore, the reason why we're so insistent on the fact that there is a proper valuation done in the prior periods is that the discount rate needs to be appropriate now to those circumstances on the reversion income, and it needs to be built up from the bottom up on what is an appropriate discount rate based on those facts and circumstances at that particular point in time. And therefore, a rollback exercise, as has happened, wouldn't be appropriate.
Thank you, Neil.
Thank you.
Yeah, very good.
So it's a question about you were talking about capacity or lack of capacity. I mean, if you'd had full capacity to do this work, would that have made any significant difference to these the material errors that have come up?
I can respond to that. Okay, so again, when you look at everything, it seems let's look at it in component. The DCO we have been discussing quite a lot, and I think for a while now, discussion we have been. Apart from this, we have been several meetings with Robin, myself, and Enya. So the DCO, I think it was coming to a point, even in January, we were saying we are making good progress and we are getting there. That was, yeah. But it's come to a point where we've provided more and more evidence, but I think we respect EY view. They're saying no, it's still EY. Yeah. Despite we've got AROP, we've got PricewaterhouseCoopers, LAL auditors agree with our treatment, but we respect the views of EY. Still, their view is we have to take out formal judgment on that. So the DCO is not to do with capacity, we dealt with that. And that's, we are coming to the final judgment on that. Capacity in terms of the pension, yeah, if we had somebody not working on the 21-22, but once we finish 21-22 account, straight away the next couple of days, that was resolved. So it's not the capability, it was just whether having the time. So, and we've already sent it to our colleagues with all the adjustment. So that was. In terms of the valuation of the airport, this is more to say whether we can take a simpler view rather than spending significant amount of getting real valuation, because the 2021 was done already. But can we take a simpler view to have a 16, 17, 17, 18, 19? But I think of the reflection, EY would like absolutely the full valuation, which we have to do, we'll do it. That's not, it's just if you had a simpler way, because we're still, I was thinking 18, 19 is just very old. So if we have to spend all this and get the valuation based on risk, that's fine, we'll do it. And I've already instructed Deloitte straight away after our meeting. I said, Deloitte, can you do that? In fact, the partner was on holiday and he picked up the phone and they said, Dave, if that's what we have to do, we'll do it. So that is being done. PricewaterhouseCoopers on holiday and standby. So that is not capacity at our level, it's more sort of give instruction to Deloitte to do it. Then the final accounting adjustment, that is very technical. So we've done our best, but I'm cut off with technical thing for a long time ago. So when you deal with those complexities, it's very technical. And that's the capacity which even I wouldn't be employing somebody full time to have the technical knowledge and just spending a couple of weeks in a year dealing with the technical thing. So that will buy it from external. So we get the technical bit from an external and do it as requested. And so this is capacity because of the technicality. Once it's solved, the next year we'll be able to follow the same principle. Yeah. So whether we could have looked at things even earlier, yes, but sometimes we have to balance the resources with what is the workload. But because of 18-19, 19-20, 21-22, and we did 20-21, it's created that pressure. And that's, I agree with, when you're dealing with all these things, plus what we have gone through with the pandemic 2 years, we were stretched. And things, yeah, then the quality suffers sometimes. But I think by and large we've managed. But going forward, we've got, as I said in my report, we've got 2 additional finance business partners now in finance department. You've got Kanchan is recruiting an additional resource in her team. I think we've got a closure accountant, which we've interviewed yesterday. There is another 2, a capital accountant and another principal accountant we're interviewing in the next 2 or 3 weeks. The finance has gone for an OCA. We look at the whole structure, the whole finance audit team, and normally in local government, an OCA can take 5 to 6 months. 80% of that OCA we've dealt with. There is 20% which is going to the admin committee. So we've done that. We've secured the service of a chief accountant. But if you say going forward, will we have sort of a pool of technically very experienced, skilled local government finance expert? All chief finance officers are saying that's not. So we'll have to train the next generation. That will take time. In the meantime, yeah, we'll have to cope with what we have. Because even right now, even getting agency staff, it's difficult to get the right expertise. So we'll buy those external expertise if we need. So we'll do that. But capacity and capabilities, I think our colleagues as well in audit sector as well, they are struggling, and in other sector as well, builders or whatever. I think it's just after the pandemic I don't know where those stuff went. So, but we'll do our best. We'll do our best.
Yeah, thank you, Jackie.
Yeah. Question. I need to be clear what we need to do here on recommendations and ensuring that, like with the capacity and extra resource, you get it ASP. Because as you rightly said, Dev, this is a marathon, and those that know me knows that I like to win. That includes the council. So I don't want us to fall over at the end and don't get anything signed off. So if we need to find the resource, we need to find the resource to get this done. So that's, I'm picking up Janet's point on with regards to additional staff, because either way we go, we need additional staff. The point that Richard made about capacity, the whole of the public sector is struggling for staff, and the whole of the economy is struggling for staff. So we can all look back and say, could we have done things different? But maybe if the pandemic wasn't so severe, people would still be in employment and things like that. So we have to navigate. So thank you, Dev. And what came to mind in listening to you and the questions, there's a saying says a good captain never learned their craft on a calm sea. So we've all learned more through COVID on what we've gone through. We just got to get through to the calm sea. So that's me done. If we can clarify what is required from here to go to the exec, so that hopefully in 3 months' time, which would be, Christmas coming then, whatever Christmas looks like, we can ensure that the work is done. Thank you, Chair.
Thank you, Jackie. I have a couple of, anybody else, Richard? I have a couple of questions, Deb. I know you're working very hard. I appreciate that. Very talented person. 4 or 5 months ago, the point was raised regarding we need some more people. Understand young Rickman, like he's working hard, everything, but they need some people to take some burden. And then I think you appoint these people. When these people was appointed?
Okay, so yeah, John was appointed a year ago. Yeah. So, and just picking up, it took 2 years to recruit the chief accountant. Yeah. And the reason we managed to recruit, because we had to put a market supplement because we couldn't recruit. Yeah. So during these 2 years, and that's coming back to the how we, I had to cope with free agency staff. So we managed to do, but having free agency staff, I had to practically had the history and everything. Then absolutely there was a report both from Deluxe and MHCLG that we have to beef up the team for the Luton shareholders group. So that we've done. So I had a very, very competent accountant with commercial expertise from private and he worked with us. He helped quite a lot. But then back in, I think in February, yeah, he decided to go to another job, and in fact, he's moved to Australia now. So since then, I had to advertise the post, and we managed to recruit somebody internal. So sometimes the council policies, the way they work, you have to offer the job somebody internal. Then if there is not, then you go an external or do secondment. So we've done that, and I've got somebody in post, experienced, qualified, work with London Borough, work with quite a lot of authorities, and has got good commercial knowledge as well. So that stuff has moved, and that finance business partner. So that's one. Then we've, in our restructure, and that's why I said the OCA takes, in a restructure, we've got a full-time closure accountant. We interviewed somebody yesterday, hopefully you might offer the job, but that's absolutely will deal with closure. And then we've got a full-time capital accountant. So capital accountant as well, 2 years, we haven't been able to recruit. So when you go there, it's just that the expertise is not there. So we've put the chief accountant already in post, finance business partner. There was resource helping me from agency, but now we've got a internal staff. And what that does is that internal staff move it, create another gap in another team. So that's why, but we would like to give opportunity. Then there's another finance business partner we've created just for housing, because we realize housing, HRA. So 2 additional finance business support we've created. Yeah. Plus overall, we've got in the OCA, we look at some of the job description into put continuity and resilience. There's quite few posts have been recreated. So we didn't just do a restructure, we do a restructure to provide resilience. So that is coming to an end, and there's an admin committee report, but bulk of this, we started to recruit some of them already in post. So yeah, this was a priority among other things to deal with the staff issue. So hopefully that restructure should take us for the next. But as and when, if there are additional pressures, right now I'm sure Nicola will share with me, coming with the looming recession or the economy slowing down is putting council budget strain. So that will require more support. And we have to do, but yeah, and we've got resource constraint in the council. So we've got to balance that need and affordability and how, but we do, yeah, Nicola sometimes will say, Dave, I need more support. I said, yeah, we'll provide that support. But we've got in all, we've put 8 additional in finance. Yeah, some will generate a revenue to cover those posts because we are going to look at areas where we can generate savings. So half of it will be self-financing in terms of generating savings, but we've got 8 posts. Plus there are other posts which we've regraded to have that continuity. So if there was an M8 and M3, we've created an M5 and deleted other posts to make sure there's a ladder to climb. And that's the way probably we can cope, is grow our own and try to train and give opportunities. Recruiting from outside, it's difficult. Competing with London Borough and County, it's difficult. We find it even in Nicola's team, it's really struggling. IT people struggle, planners struggle. Yeah, so it's a reality, but we'll have to make sure as officers we deliver the service. And as I said, when you put in context over 2 years, what we've gone through the pandemic and what we've produced in terms of report and dealing with SIPFA, dealing with deluxe, dealing with special force managers, it has. But yeah, it does stretch the team. I have to say, yeah, we are stretched.
Yeah, thank you, Dev. Yeah, I can understand that because of COVID, it was an unprecedented time we spent and budget cut and everything is affected, council is affected. But as with these concerns, I hope will be dealt seriously and very soon. Obviously, without these concerns, Ernst and Young's, they're not going to approve this 18 and 19 budget. In my understanding, obviously, you did a lot of work, very hard work. Thank you very much for that. And as you said, you can deal with these things, 5 points there is. Committee, in my point of view, is no point to go with the disclaimer approve. We can wait a little bit more and give you some more time, and you can address these issues, and then we finalize 18 and 19 accounts. Is that okay with the rest of members?
Yeah, the resource issues.
Yeah.
The resources already been addressed, so we don't need to make a recommendation to the exec or anything like that.
No, no.
And that's been included in that will be included in the budget going forward. Excellent. Thank you.
It was already approved in 20. I'm losing track of dates now. In this current year's budget, 22-23. Yeah.
Yeah.
It was addressed. Yeah. Just recruiting and training them, and going for that OCA. It's yeah. But if we need the technical resource, whereas Councillor, you mentioned, that will buy it from outside, because we won't be paying somebody full time having that technical expertise. And these are the things is that the pandemic is once in 100 years. So these sort of dealing with 18, 19 accounts, let's hope we don't come to that. But if you've got it, I'll get a technical expertise from outside.
So, Chair, when are we looking for this to be done?
That's why I'm going to ask the question,
Chair.
Deb. Yeah, yeah, Deb. Roughly, I know you can't give us exact time, but roughly to address these issues, the main one is valuation one. Yeah, how long it will take?
I think by the time they go through the quality assurance, one Deloitte has done that, then our colleague Ernst & Young will have to go for their state team, their professional standards panel. I would say maybe 6 to 8 weeks. Is that reasonable? Because Deloitte, hopefully by end of September, will push them to do that. And hopefully then another 4 weeks for EY to go through that valuation, because it's 3 years valuation. So I'm just guessing here.
So are we saying December, because capacity and everything is still not in a good place? Sorry, Chair. Are we talking, or just be realistic and say Jan? But
No. I would say, look. The other thing which I have to explain here. November, December, we are in full budget. Yeah. Yeah. So I would ideally get it done by end of October. Push that. Yeah. End of October, November latest. But because January we are in full budget, and then after January we got closure, then the whole thing can delay by 6 months. Because then you're doing budget, you're doing closure of accounts in February, and you'll be dealing with, So I will be working, make sure before we hit the real, but we are already in budget, but before we hit the November, that's where all the budget papers and everything, I would try to work with our colleagues, but Deloitte is already working on that now. In fact, I had a call from Robert yesterday. They want to just clarify it exactly so that they don't get it. Yeah, exactly. Yeah.
EY needs to sign it off. And I know that there's issues in the audit profession on capacity. So that's what I'm saying. All the bits need to join up. So to come to us. That's my concern.
I don't know about Janet. If I try to if I try to get Deloitte produce that valuation, and the pension is resolved, the disclosure, my team is working on those. If we get this end of September, that's what I will be aiming from. Because then the focus will be so then it will be very much EY.
Okay, Deb, thank you. Just take one more question on this item from Underwood. Then I will give time to Janet to respond. Then we move to next agenda. Yeah.
Thank you, Chair.
Good.
Thanks, Chair. It's just to know it's the same point basically, that isn't there a risk that this is not going to be resolved in the time frame you mentioned by October? I mean, it hasn't been resolved so far. So what is going to change between now and then for this to be resolved?
Two things which are going to change. One is Deloitte will do the valuation, which they've done it already for 2021. So if they follow the same principle, then they do it 16, 17, 17, 18, 18, 19. It's a question for them to get this through their quality assurance. So it's not that they haven't done it before, it's just they have to do it for 16, 17, 17, 18, and 18, 19. So I made a plea to them and they said they will prioritize that. And PricewaterhouseCoopers, The rest of the issues, DCO, I think we've already agreed. So that is resolved. We'll agree on the limitation of scope on that one. Infrastructure, I said, when we met about 6 weeks ago with Robin, we've already agreed. We said that's what the council is following. So that's resolved because we'll go until In terms of pension, we've already resolved. It's just EY to look at it if they're comfortable or not. It's not the bit which we will be working in our team with the disclosures. And there's just 3 or 4 disclosures, not, it's prior adjustment and so on. And we've disclosed quite a lot in going concern. John has worked a lot on the going concern note. So just there's maybe another 20% of those disclosures to fine tune, make sure EY are comfortable. So that's our team will be. That's why I'm saying by September, I'm aiming to do that because it's a distraction for everybody. So I will aim to get it done. So that's why I'm aiming at September, get these things done. But then we'll be discussing with EY and keep EY involved throughout the process. So when we get it on September, it's not that we have it agreed on the basis of those assumptions on which the valuation is being done. So we'll yeah. So we've got hopefully 4 weeks to get it done.
Thank you.
That's
Janet,
my
please.
So on the valuation, the basis of the valuation and the methodology is agreed already because we looked at that for the 2021 valuation. So it is that the full valuation now needs to be done. And then that, and I'm sorry, I'm going to disagree with Dev. He said that there's about 20% of the disclosures which need just fine tuning. We wouldn't be talking about a disclaimed opinion if it was just a little fine tuning on a number of disclosures. There's some fundamental technical issues that need to be flowed through those disclosures that are complicated, which we've already discussed, and require some technical expertise. So my proposal is that the valuation needs to be done, and obviously we're more than comfortable to continue that discussion as that progresses. But then the full set of accounts needs to be worked on and presented. And my point in my summary was you need to do a quality assurance process of that of your own before we then step back in and have a look. Because my concern, to your point, Councillor, is the amount of time that it's taken us to get here. That's a highly ambitious timetable to get to the end of September and say, here you go, Janet, this is all resolved. I think that's unlikely to occur. And what I do not want to do is commit more resource from my team, because we are all stretched, until we're ready to look at something that's the complete article. Now, I already put a highly senior team on this, and we've been working through. I will continue to have to pull a highly senior and technical team of my own to the detriment of other work to get this resolved. So I just want you to understand as an organisation just the amount of effort that needs to go in from our side to do that. And I would like to have the finished article before we then come back in and complete this. And I don't think you'll be there at the end of September.
Dave.
EY colleagues, they've gone through the accounts. And big thank you to Neil. He's put all his comments. If I ask EY, if, just a hypothetical question, if you get one of the technical equivalent of EY from Deloitte or from Mazars or whatever firm, top technical person who do this at the full-time job, how long would that take to correct those? Not me, not my team. I bring one of the top technical manager partner, expertise to do that. How long will it take to correct? Because you've gone through.
It would probably take a couple of weeks.
Couple of weeks.
Once they've got all of the data points.
Yeah. So a couple of weeks. I've got one on standby. The valuation is being done as we speak. Now it's very much they're coming back on the holiday, otherwise they would have started. That I will get a time frame from them. PricewaterhouseCoopers already on standby to do the deferred tax liability. The rest of these things has already been, so we can resolve those, the infrastructure asset and everything, DCO. If a couple of weeks, somebody technical I will get that technical expertise. That's why I'm aiming for end of September.
Janet, sorry, Chair. Janet said a bit about quality assurance. So who's going to do the quality assurance? Because I would see it needs to be internal audit, or we get somebody externally to do that. I just don't want
external.
This right.
External.
So and I can understand EY's point professionally with regards to the resources. So I understand crossing the T's and dotting the I, and so that when we present to them, we have a high level of assurance that there ain't going to be nothing coming back. And I think it would be prudent to spend the time and get it done, and that we're not here saying something we missed.
Yeah, and I think Neil has already gone through those. Yeah, and we have been discussing the accounts for quite a while. So here, even if we have the best of our staff here, that technical bit is missing because it's technical. So we'll get that external. It takes 2 weeks, we get, and I can't do a quality assurance on something highly technical of that nature. So that if we get an external firm to do it, I've already discussed with one of our consultant who provide us with expertise. But if I say, charge me for a week and go through that and get it resolved, 2 weeks, we'll do that. So they will go through their own quality assurance process. The team will do that. They will come and then say, here's a set of accounts. Now, the other thing which you to bear in mind that, okay, we'll come to a point because you can spend another 3 months just fine tuning everything. The accounts at the end of the day will have to give a true and fair view. So there might be certain things which we might be spending more and more time. We'll have to form a view somewhere. And if that technical team, we'll get a top technical firm to do that. And if they come up with, then we agree with EY. So as Janet says, 2 weeks, I will get that resource and yeah. If I don't get that resource and Deloitte are saying it will take longer to do that, then I will inform the chair and Janet to say. So I will work from a detailed timetable with those who will work on that and get it resolved, because I won't be resolving those issues myself. We've done as much as we can. As I said, the council accounts are okay. The bulk of the account is LBC accounts. So there might be some minor things, but LBC accounts are correct. The pension one is done. It's just a group, and that's where it becomes. And group accounts is technical. Yeah, but that's my aim, because we all would like this to be resolved, and we won't be sitting here discussing. So I'll get that technical expertise to do that. That's my I will aim at that. Yeah, thank you.
Yeah, thank you, Jackie. Thank you, Dev. No more questions. I need to move. Yeah, as Dev, I said, I hope you will address these 5 points seriously and try to address these very seriously. And the time scale you gave us, even a little bit more, you can. I know it's roughly, yeah. And I hope from Janet and Ernest and Young team as well, they will help and advise if Dev need, as you do in the past. You did in the past as well. So we will somewhere together, we will get our destination or place. Is that okay for everybody? Thank you. Can I move to next item is value for money. It's a same 10 item agenda.
Thank you, Chair. So I think for the sake of timing, clearly we've covered one of the key issues already, which is around the financial, the capability and capacity within the team. And that was the main area of focus within our report. What we've done is reiterate a number of areas that we made recommendations on in January 2022, and just updated our view of the risk environment associated with those areas. So one is around the financial sustainability and borrowing, and the other is around the functioning of the stakeholder group that looks after the decisions around LAL, and whether there is further work that can be done to make that in particular more transparent within the functioning of the council. So, as I say, we've revisited and updated our recommendations on those financial and governance risks that you face as an organisation, because we think it's important to keep those at the forefront of the organisation's mind as they are operating, and giving you our external auditor's view on those.
Yeah, thank you. Any questions? Yeah, Dev.
Yeah, that's right. This is the bulk of this value for money was discussed back in January as well, very detailed. So absolutely, we agree with, given the current economic climate, given where we're heading in terms of inflation and interest rate, we have to keep it under review. And as you mentioned about the treasury, about the interest inflation. Absolutely, we'll have to keep it constant under review and look at our investment, look at everything. So absolutely, I agree. We have to. And just to say, the Luton shareholders group, we've met on few occasions, and we've already appointed 3 firm of external advisors to advise the council and the LAL shareholders group. Not LAL, Luton shareholders group. And first is Deloitte, advising on commercial and financial. Then we've got Bevan Britain, advising the council on legal. And you've got Jacobs, who did the review of the DART, and they're advising on the technical and operational. So we've got 3 already, a contract for, I think, 3 years. And we've already using, so on one of the project, Deloitte has already worked with our team on one of the project which the LUF bid. So we've got those, and then we'll yeah. But we agree with what that we have, because we've got an investment and we've got an airport. We've got to make sure that we do whatever due diligence needs to be done, and that's what we've done in the past and we'll carry on doing. Thank you.
Thank you. Councillor Underwood.
Thank you, Chair. It's just a quick question. You're talking about recruiting expert advice for the shareholders group. Mentioned commercial and legal. How about the aviation and air industry expertise?
The aviation is what, for the commercial one is Deloitte. So they've got expert in aviation. So Deloitte will be doing the financial modeling aviation sort of advice. But we have to be, just to point out to members, LAL has got their own advisors, yeah. So ROP is one advising LAL, we've got QC, but as a council, we've got our own advisors to do that extra due diligence on what is coming from LAL. So Deloitte aviation expertise will be working on any things related to aviation from a council point of view. Thank you.
Thank you, Councillor. Anybody else? Thank you. Thank you, Janet, for your report. A move to agenda item 11 is a draft unaudited statement of accounts from Dev.
Thank you, Chair. Yes, so there's a presentation which I suggest we do first, and then we can actually look at the main report. The presentation I will try to whiz through. Request for members previously to have a backdrop on the accounts for previous years, particularly balance sheet and other movements. So what I've pulled together is firstly some regulations so that we understand the context of it. I shan't read it all out there; they're all there, and that's the context within which the framework within which all authorities operate up and down the country. So we've got to prepare the accounts. They've got to be accurate, timely, etc. The relevant level of resources, the sorts of things we've been discussing this evening, really. So that's the framework within which we operate. Next slide, please. And the process. So you can see that the boxes there take us through where we are, reporting and the framework, preparation of year-end accounts, the governance within which we work, and importantly, I think I'll just draw here the purple box third down, scrutinise and approve the accounts. So here we are, the 1st of September. We've just yesterday added the accounts to our website this week for 21-22, and they are now open for public scrutiny for the next 30 working days. So we're slightly late, as I think it was outlined in the previous audit committee. The guideline was for the end of July, but I think we've been through the reasons that was slightly delayed. And quite clearly, after tonight's conversations, the final account sign off, external audit, etc., won't be this 30th of September, given some of the conversations we've had, so that'll be delayed as well for the same reasons. Thank you.
Thank you for your report.
Sorry, Chair. I'll be clear. I'll ask Matt to nudge them on. I do apologise. Yeah, very eager. Okay, the actual main report covers these in detail. So to be clear, the 4 core statements that every authority in the land works within are those there: the income and expenditure, the balance sheet, the movement in reserves, and the cash flow. So that's the framework. So you compare like with like, and everybody is using the same sort of format, so that it's obvious where the differences are between the different types of authority. Thanks, Matt. I shan't go into all of these in detail, but only bring to you the main issues that are not covered in the report. So in terms of movement of reserves, there's a necessity to take the just over £5 million surplus that we had from the financial monitoring report and adjust for all the movements we've made in the year from balance sheet items in reserve to see what that would look like without those adjustments being put through. And the gap there refers to the generally accepted accounting practice across the UK, and it's to show the impact of reserve movements on the outturn position. So the income and expenditure report will be a £26.25 million deficit if it weren't for all the raft of things that we've done that I list and summarize in the bit in the middle in that slide to give us what we actually reported. So it's really just sort of assessing where you are without those balances that you've got at your disposal. And of course, those balances are there for a reason. That they're reserves and other balances that have been accrued over a number of years for particular purposes and eventualities. So that's movement in reserves, really, that particular slide. Thanks, Matt. Okay, so the income and expenditure, this is a summary of what's in the report. This shows year 21, 20, 21 to 21, 22, the differences. And I'm sort of suggesting here, telling you that the grants and other major changes due to the COVID is the fundamental difference between the 2 years. And also there's a sore thumb in as much that it kind of stands out and changes things a bit. Favourable changes in financial assumptions around pension actuarial reviews, which actually don't affect us in terms of cash, but do affect us in terms of actuarial reports that we must take heed of and reflect in the account. So that's the major difference between the 2 years. In that white row between the 2 blue ones are the comprehensive income and expenditure. It kind of skews things, so it's worth pointing that out. And of course, in the statement of accounts, all these things are described in more detail. So this is really just a summary for quick reference. Thanks, Matt. And the balance sheet for the group, much conversation tonight already. I would immediately say that the valuation for the airport is not yet complete for the year 21-22. And of course, the accounts aren't signed off for the prior years as well. So everything has got the word draft over it, and this is no exception. So there's asset changes, mostly represented by increases in investment properties and revaluation of assets, long-term liabilities due to the subsidiary loans that the authorities made. Deferred tax liability for LAL as well. We've mentioned that this evening, and that's also reflected here in the group accounts. Usable reserves affected by the pension liability and the HRA revaluation increases. So there's rather seismic monetary values here, but we explain them in detail in the accounts. And this was the group to give you a sort of high level perspective across the 2 years and showing the change. Thanks, Matt. One of the statements is cash flow. This produces a cash flow statement and a synopsis between the 2 years. And again, it's movement in provisions of service across the years, less COVID grants in 21-22 than there were in the prior year. Change in investing and financial activities represented by changes in PWLB position, net repayments, etc., that sort of thing, and changes in cash and cash equivalents. So there's at a very high level that's showing where the cash is coming from and where the cash is going in terms of the local authority accounts. Thanks, Matt. One thing that we thought would be good to point out is how our investment properties fare between the 2 financial years. You can see asset value of the investments, 117 million for 2021, rising slightly to 120 for the following year. But yet there's been a change in the rate of return, explained in these 2 points here. Firstly, there's income reduction due to natural cycle of leases, where there's obviously periods of voids and so forth, and periods of inducement to get new people into those dwellings, to get new income streams off the ground. And there was an issue of a further expenditure in relation to the acquisition of Preservation House. So we're not disappointed, but there is a slight change of 1% in terms of the rate of return. We would always seek to get something above 5%, and that's not a bad position. So we're in a position of strength really across the 2 years, and hope for that continues into the future. Thanks, Matt. So the housing revenue account movement, so you can see first year, the second year, and the variance. You can see those changes, and I'll describe them very briefly in the following slide, Matt. Thanks. So income received, not big. Expenditure incurred is also a fairly modest figure, mainly depreciation changes. The big issues being total assets in terms of new assets acquired, and a high value in revaluations with depreciation and some disposal. So this is the sorts of thing that have an impact on the balance sheet, on the accounts each year, that we will take stock of. And there's a change in the HRA fund balance as well. Mainly the surplus for the year has increased that. So thanks, Matt. Summary balance sheet for the authority, single entity. So earlier we looked at the group. These are the single entity figures, and what we're now seeing is, I think the committee did request that at some point is a 3-year analysis. So 2019-20 to 2021 to 21-22. And if we look at the following sheets, we will describe some of those changes. Thanks, Matt. So there you go again. It's high level things to do with additions and revaluations. The loans to the airport and Vauxhall Homes in terms of increase in investments. Some increases in debtors due to decisions made during the year that can have some fluctuations, and other minor issues. The pension issue, again, as I alluded to earlier, is quite an enigma really in its own right, but because it throws out such big figures. But when you consider the size of the Bedfordshire Pension Fund and the pension funds up and down the country, you can begin to sort of understand how you've got these changes. And the pandemic has, of course, had an impact with asset valuations in pension funds being affected. So there's some changes caused by that. Thanks, Matt. And much the same things really here in terms of the assets and liabilities. It's the same story. It's about valuations. It's about changing in investments, and it's about increasing in longer term borrowing. That are affecting the figures at the highest level you can get, and they look quite staggering, quite high figures. But of course, we are dealing with a large local authority in terms of the assets and liabilities and the net change across the years. Thanks, Matt. And then the longer version, the other side of the balance sheet. So you got your assets and liabilities underpinned by reserves, usable and unusable. Usable reserves are exactly that. You could use them as you wish. Unusable, there's various rules and regulations about the time when those balances can mature and be used across the accounts. So that there's a subtle difference which is explained more in the accounts. Thanks, Matt. These are the main changes, and again, it's the usual things around valuations, and in this case, we've got the capital, including deferred receipts and financial instruments, having an increase of 17 million on the unusable reserves, and other minor incidences. But again, our friends, the pension scheme liabilities, that's a big issue, and it does tend to stand out when you look at the accounts at this kind of a level. Thanks, Matt. Same issue here, really, changes in reserves. This is 1920 to 2021. So we've got earmarked funds where we were able to invest new monies, and in some cases utilize some of the funds. So this is where we're using earmarked reserves for specific purposes for which they were labelled at any time in the past, and in the same way, we're putting up some new reserves to act as a nest egg for the future, really, to safeguard against eventualities as and when they may mature. Revaluations again, and pension liabilities again. It's a common theme, of course, as I think you've probably picked up by now. Thanks, Matt. So in terms of the usable reserves, you can see the pattern again, 1920, 2021, 21-22. It's looked more healthy as we've been able to invest money into usable reserves, and then there's been a slight difference between 2021 and 21-22, which I will talk you through just in a tick. Next slide, please. So in terms of 2021 to 21-22, there's a minor variance overall, and you can see how they are depicted here. Point to note, inflation reserve created. Dev and the team, we were talking about this in about the turn of the year, and it was obvious that this would be a good idea to do. In the event, we've allocated 2.5 million towards an inflation reserve. We all know about the problems with double-digit inflation at the moment and the cost of living crisis. The only thing is that enough? I mean, we don't know, but it's a start. It's a provision. It's a safeguard for the future in terms of the problems and the pressures that the authority faces with such things. And you can see again HRA reserves and capital minor changes in the overall scheme of things. Thanks, Matt. And more seismic movements the previous 2 years, so 1920 to 2021, where there was some funding equalisation reserves for the same sorts of reason. You put money to one side when there's pressures and problems that you're facing or anticipating to face into the future. The demise of government grants and the reliance on local authorities to consume their own smoke. The pandemic having an impact on the airport functioning, etc. It was prudent to make such commitments for safeguard against future pressures. I think that's probably the main point to draw from that one. Thanks, Matt. The group accounts, of course, cover the airport and Vauxhall Homes. That's a simple statement. In future, we will probably have Connect to Luton in there as well as that business escalates. Thank you. Next one, please. I will hand over to Dev for this one.
I think just thanks, John. So last committee meeting, Chair, you've asked for a freer balance sheet, so that we've presented. So if that meets your need, fine. But if you want to have a much more detail, we can do that. So that was the 3 year, just to explain what has been the movement over the last 3 years. Then yes, there was Councillor Wahid asked a couple of questions, but unfortunately he had to leave the meeting because of being a director of LAL. So what you see here is in 12-13, the amount we were getting from dividend and interest was in the region of 7 million. And then because of the discussion with LOL, and we had the mechanism in order to increase the passenger numbers and to incentivize the airport to grow and increase passenger numbers. So you will see in 1920, the figure started to go up. So we started to generate a much higher interest and dividend, and the trigger point was around 16-17. That's where we had a growth mechanism to help the airport grow. So around 2010, we went back 2010, 2011, we were receiving around 6 million. And then in 2012, 2013, roughly, in 16-17, that's when we started to get this passenger growth mechanism to help the airport to grow. And then in 1920 was the region of dividend, but when we've lost a dividend, but 2021, that's the interest. So you will see in our medium-term financial plan, we've removed reliance on dividend completely. So we're not using dividend to balance a council revenue budget. Even we are not putting any dividend, the whole idea is to bring a more resilience within LAL. So any profit LAL will start to generate, and that will start to generate because passenger numbers are improving, will create a reserve there, because they had a reserve around 12 million, but because of pandemic, they had to use that reserve. So we'll create a reserve, and then we'll think, and if any dividend which LAL will declare in the medium-term function, that will go toward the council capital expenditure. So to be cautious, prudent, we're not relying on dividend to fund the council revenue expenditure. So I will share a copy with Councillor Wahed. He's got a copy. I'll have a chat with him. And he also asks about use of reserves. So that's why we've got 3 years, which John tried. But if any member would like to go back even a couple of years, we are quite happy to have that. So it shows you over 1920, as John said, when we had some upside in terms of some one-off gain, we have been building some of the reserves. And that's what we have been doing. But now it's yeah, we've got those. And Councillor Richard mentioned about doing internal borrowing. So you will see on the reserves, one of the slides, when you look at the schools reserve, HO reserves. So at any particular point in time, those reserves are cash. So rather than keeping this in the bank, we do that internal borrowing. And that's where you will see on those. Yeah, because if any schools, we pay some interest, but we've got those balances, HO balances. We try to use those cash rather than borrowing external. Thank you.
I think there's just a couple more. Thanks, Matt. So the annual governance statement, for completeness, the statement of accounts that's been loaded to the website is in draft and is being considered by the report that I'm about to present, covers the annual governance statement. And these are the bones of what the annual governance statement does. So it replaced the statement of internal control a few years back, will be part of the final accounts to be considered at this meeting, and the main components are set out. So it's about the governance arrangements, Luton 2040 visions, responsibilities, constitution, that sort of stuff, effective reviews of effectiveness. The Kanchan and the audit team do a number of audits every year, and there's some results of those. And as a result of that, there's a review of internal control issues. One of them identified, which I've mentioned here because it's in the annual governance statement, was around reconciliations. I would say that a lot of work's been done since then, and we're pretty much there. There was an issue about a new reconciliation system coming in just before I joined, and there was some issues in getting that to sort of dovetail properly with Civica. And if I'm honest, I don't think we had the right sort of level of testing with Civica as they brought that in. So we've now overcome that, but Kanchan was quite right to bring that out as an issue for one of the reports. But we've got some good news as a result of all of that. So the annual governance statement comprises part of the statement of accounts, and that's also in the main appendix for the main report, which will be considered in the fullness of time. But we're asking for the draft to be looked at tonight. And I think that may be it, Matt. Is there one more? Questions, of course, yeah.
Thank you for your presentation. And any questions? No? Thank you very much. I think that's, oh, Deb, sorry.
Just to mention now what the process now, normal process is, this is draft unaudited. So once we get through the audit, so this will be, and that's why I would like to get the audit and the account signed ASAP, because we've got 21, 22 accounts as well. And yeah, so right now, normally, once the audited accounts come with audit report, then we'll ask the chair yourself to sign, and the annual governance statement gets signed by the chief exec and the leader of the council. Yeah, thanks, Chair.
Thank you. Anybody else? Thank you very much, and see you next time. Bye-bye.